Good afternoon, everyone, and welcome to Unlock the Stock with Equites Property Fund. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and get to know them and their companies better. This event is sponsored by Keyter Insurance and FX, an FX and intermediary and insurance brokerage for niche markets, which include bloodstock, sport horse, and game insurance, as well as household, vehicle, and commercial insurance. Whether in the insurance business or FX, Keyter are involved in matters that affect people's lives. Keyter Insurance and FX in your corner. So please visit their website, www.keyter.co.za, to meet the team and read more about the services they offer. This platform would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com. And you can visit to find out more about their various integrated online AGM and investor presentation solutions. Our hosts will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will facilitating the Q&A at the end of the presentation. We would like to welcome Equites Property Fund, represented by CEO Andrea, Taverna-Turisan, who will take us through the presentation, and Lila Razak, the CFO. Before we commence, a couple of housekeeping rules. Equites Property Fund will do a short presentation, and please note that you will only be allowed to post your questions by typing them into the chat function at the bottom of your screen. This event is being recorded and will be available on Keyter Rech Investor Solutions YouTube channel, so be sure and subscribe to this channel. During the Q&A session, you will see an email address if you would like to be added to that company's distribution list. I now hand you over to Andrea. Andrea, can you please share your screen with us?
Fantastic. All right. Well, welcome everybody. It's a pleasure to be here with Unlock the Stock. It's our first time that we do present on this platform, and obviously a welcome opportunity to speak to a broader audience too. So, page. Maybe we can start with the company, just a brief introduction. Myself, Andrea, Taverna-Turisan, Equites Property Fund CEO, listed the business with Rech in 2014. We actually listed on the 18th of June, so next year will be our 9th anniversary. So it's been a really incredible journey. We listed with about R1 billion worth of properties at the time, which included my own personal portfolio. And as of 31st August 2022, portfolio was just around 26 billion. So we've managed to grow a fantastic portfolio, and in the process have really added to the underlying fundamentals and quality of the portfolio. Currently, the portfolio is about 60% in SA and about 40% in the UK. Lila Razak is our finance director. She'll be talking to you a little bit later on. And Lila joined us just after listing as a finance manager and became CFO in 2020. She undertook as her first punishment her first audit at the year end during the middle of COVID. So it was an online audit. That was an interesting time for us all. We can go to the next one. If we can maybe start with the strategy. So Equites really is a very focused REIT, and we are very specifically targeting the logistics property market. We in terms of our strategy, we've got a single-minded focus of actually trying to become a globally relevant REIT in this logistics sector that we talk about. We only invest in the SA and the UK at the moment. Our strategy is really to try and get long-term leases from blue chip tenants. So as you can see from our weighted average lease profile, we currently have an expiry profile of about 13.9 years across our portfolio. And some of the blue chip tenants that we have multiple leases with include the DHLs, the DSVs, ShopRite, TFG, Simba, Simba's actually PepsiCo to mention some. In terms of the product that we tend to sign, it would be what we call a triple net lease, where effectively the rent that we receive from our tenants is net of all costs, and the tenant has got the obligation to fully repair and maintain the property during his occupation. We run a pretty conservative balance sheet, and that's also a function of the fact that we do quite a lot of development work. So we try and keep our loan to value sort of between 30 and 40%, and effectively have always been in and around that area. We create the alpha value, for want of a better word, by our development pipeline. We undertake developments both in the UK and in SA. It doesn't mean we don't buy, but we rarely do buy. We tend to develop, because one of the main reasons, obviously, is firstly that especially in SA, the quality of property that we would want to acquire rarely comes to the market. And then the second point is obviously our specification in terms of our product. It's an extremely high quality product, and not everybody is prepared to develop to those standards. If I can just maybe unpack the difference between the two markets that we operate in, I think it's quite important, and I think you see it from the graph on the right. In the UK, what we tend to have is a 5-year period where you have no increase in rent. And then at the end of that 5-year period, effectively, depending on what you have negotiated, you can either have an index-linked escalation, which tends to be linked either to CPI or RPI, or you have what they call an open market valuation escalation, which is linked to properties in and around a certain radius from your property. And the function of a market that is growing normally leads to rentals that grow sort of way beyond inflation, which is what we've been experiencing in the last 2 or 3 years in the UK. And as a consequence of that, we find ourselves with a portfolio of 12 properties in the UK, 7 of which are linked to OMV, open market valuations, which we expect to, which will be coming through a rent review within the next sort of 26 months, all 7 of those properties. And the expectation is that those properties will get escalations of between 35 and 45%. In South Africa, the market obviously slightly different in as much as, again, we're chasing long-term leases as well. So in the UK, the leases tend to be sort of between 15 and 20 years. In South Africa, we tend to get 10-year leases with development. The ShopRite being the exception, where we've managed to achieve 20-year leases with them. The difference in SA, though, is your lease has an annual escalation linked in, and it's normally a fixed number. In current times, based on where inflationary pressures are at the moment, these escalations are normally between 6 and 7%. However, there are times, in the last 20 years, those escalations have been anything from 10 and 11% and all the way down to as low as 5%. So they are really a function of where inflation is perceived to be in the marketplace at that particular moment in time. Next, maybe. In terms of the portfolio, as I said earlier, the split is 39 in the UK, 63 in SA, predominantly in Gauteng and the Western Cape. Obviously, we do have one property, one property at the moment in KZN, and we'll be transferring a second one hopefully before the year is out. Okay, next property. These are obviously, we mentioned earlier some of the names. These are obviously some of the names that sort of make up our portfolio, and obviously it's always a pleasure when rental is paid on time. Next. Okay. In terms of our expiry profile, you can see from the graph on the right that our expiry profile, obviously, with 66.1% of our leases expiring sort of after sort of 2027. This obviously allows us to be very focused in terms of trying to grow the portfolio and develop what we can, but at the same time, what it does gives us the opportunity to really engage with our tenants, as we don't have a crazy amount of tenants, but we tend to engage with them a good sort of 12 to 18 months before expiry, to really fully understand what their requirements are, and if there are opportunities to develop bigger space for them, whatever. Repeat business with existing clients is quite often the cheapest business that you'll do. So it is something that Equites tends to try and do a lot of. But more importantly, by engaging early, we are in a position to potentially offer certain incentives for clients to stay on. One of the key incentives that we are sort of working with clients at the moment are sustainability linked incentives. And that would include sort of, water management and as well as energy management with PV and the rest. And that being obviously very relevant, especially at the moment with the troubles that Eskom are having in terms of the nation. And that really does help on that, from that point of view. As I said earlier, 97% of our income, as I said earlier, is we tend to sort of focus on A-grade tenants, and 97% of our income does come from those tenants. The South African portfolio at the moment is about 1.3 million square foot. And what's also quite interesting about that, and the reason square meters, sorry, in the UK we talk foot, square meters. And what's interesting is that on that is that roof space is all inside the urban edge, and and Leila will talk to you about it in a bit more detail later, as we enter the optionality of potentially wheeling and creating energy, there is an opportunity for us to create an extra stream of income in due course over time. Okay, I'm going to hand over to Leila to take us through some of the financial metrics.
So I didn't say the statement, but he's quite well known for saying it. Our business is fairly boring, and if we're boring and predictable, that's what we're doing our jobs. And the reason that real estate investment trusts were created in the first place was to give investors the opportunity to replicate a property investment. So what we're doing is investing in properties. We have the benefit of scale through creating a portfolio, and really to give investors steady, predictable stream. So at our last reported results, we grew our dividend or distribution per share by 4.1%. And that was underpinned through the way that we structure our business. We intend to keep providing steady and predictable distribution growth. We also at the same time delivered a growth in our net asset value per share. It was 0.8%. Typically, we've experienced a contrast in the two markets in which we operate. In South Africa, historically, for the last 2 or 3 years, we've had fairly weak property valuations, and this was countered by very strong property valuations in the UK. And at August, we had a reversal. So we had very strong valuations starting to come through in South Africa. And in the UK, I'm sure that most of you are aware of the economic uncertainty or turbulence in the UK. We had a slight come off in UK valuations. So that is hedging at its finest, I guess, but in the opposite direction to what we used to. We pay 100% of our dividend, of our distributable earnings as a dividend. We will maintain our distribution or our dividend payout ratio at 100%. Our loan to value, as Andrea said, we maintain a conservative balance sheet, so loan to value of 33.3%. We've typically stayed on the bottom end of that 30 to 40% guidance, but we are comfortable operating within that range. And then when we reported at August, we had 1.4 billion rand of liquidity in the form of cash and undrawn facilities. If we skip on to the next page, we are a property business, which means that we're capital intensive. So how do we fund our acquisitions and developments? Historically, we've had very good access to the capital markets. We've raised capital through accelerated book builds, but it's not the only way that we raise equity. We usually have a dividend reinvestment option where shareholders can elect not to take their dividend in cash. They can elect to reinvest it in the company. All shareholders are treated equally, and that's usually quite well supported. So through accelerated book builds and dividend reinvestment programs, we've raised 10 billion rand through the JSE since listing. In addition to that, we have exceptional access to the debt capital markets. We recently concluded a debt auction, which was well supported. We raised 1.25 billion on the debt markets. And then in addition to that, we've had to look at other ways in which we can raise equity. So some of those are disposing of non-core assets in the South African portfolio. It's forming joint venture relationships, such as the one with EPPF, where we acquired the DSV campus. And then in addition to that, we also, Andrea will touch on the UK business, but we generate internal profits in the UK. So through either the disposal of land or through turnkey developments, we generate profits which we don't distribute, which will form part of our capital reserves. But Andrea will touch on that a little bit more when he goes through the UK. So really a variety of mechanisms to raise both equity and debt capital. If we move on to sustainability, I mean, I think this is one of the most exciting elements of our business right now. For the first time, we have the opportunity to really do something which is good for the environment, for the country, but also makes economic sense for us. So sustainability is really ingrained in everything we do. But the E, S, and G, but for now, I'm just going to focus on one element, which is the E. At the moment, we've undertaken a sustainability audit where we've looked at every single property in our portfolio, and we've engaged with certain tenants to understand how we can bring their product into the 21st century, whether it's installing solar to generate electricity which they can use, renewable electricity which they can use, their water interventions, grey water treatment, rainwater harvesting, those sorts of things. But at the same time, what we've done is we've assessed the entire portfolio and seen how we can contribute to producing renewable energy and selling this back into the grid. So we've been accepted into the pilot project for wheeling in the city of Cape Town. So we will be one of the first clients or producers who will start generating electricity and wheeling it in Cape Town. This will start in January 2023. At the moment, we currently produce 8.3 megawatts of electricity across our portfolio. With our pipeline of electricity projects, we will produce an additional 5,500 megawatts of electricity over the next 18 months. Now, that's considerable. And this doesn't stop here. We're constantly looking for new ways to bring electricity to the grid and to our tenants, and constantly looking for ways to reduce our carbon footprint. So this is just part of what we're doing. It makes us really cutting edge and at the forefront of sustainability. I mean, awesome. Yeah, handing back to Andrea.
Thank you, Leila. And then I think let's just go to the UK. I think it's quite poignant here. You'll see the 13 sites that Equites currently control. We can start with number one at being up at Barnsley. Obviously there we almost complete. We built a Hermes facility there, which we've retained ownership of. That was completed earlier in the year. And then we are currently building two facilities at the moment for an American asset manager, which we will hand over in December to them. And they are looking to rent them. We are trying to assist them in that process, but we take no vacancy risk. We take effectively on that particular deal, we will make £5 million profit after tax. So 100 million rand, and sort of referring back to what Leila spoke about earlier, that 100 million rand obviously goes straight down to our bottom line, but we do not distribute it. Over and above that, we have a property in Junction 24. We have a property in Rugby at Coton Park. We have a property at Newport Pagnell, all of which effectively the original planning consents have been granted. And we are in the process of effectively going through judicial reviews. And in some instances, we've got detailed matters, which are effectively the specific building plans in for certain operations. The site there, obviously number 5, is known as Peterborough Gateway. It's a site which is now 100% complete, and we currently own a facility which is let to Amazon, which we completed in September 21. And that whole park is now complete and done. We believe that these various sites will come onto stream at different times over the next sort of 3 to 5 years, and the total deliverability of the sites in terms of bulk is approximately 15 million square foot, which is about 1.4 million square meters of space. And I mean, if you were to put top structure and all of that, that would be equivalent to about £2 billion worth of product. Now, as Leila said, there's no intention for Equites to own it all. We believe that there'll be a fair level of turnkey operation where we will also do developments with tenants on a pre-let basis, but we'll look to sell the product into the open market and actually make a capital return as well. And we look to cherry pick and look to retain ownership of the really, really blue chip stuff that we believe will sit comfortably in our portfolio for the long term. You can go next, Lainey. Thank you. In terms of, I suppose, the history of the organisation, we've only got the recent history here from from 2017. But as you can see, we've pretty consistently traded above book value. We had a bit of a fall off, if you like, during the COVID period. And then we came roaring back post-COVID. And then I think with the uncertainties that have come through following the Ukrainian invasion, the inflationary pressures and the interest rate cycle that has sort of come through global markets, if you like, I think there's been obviously a lot of negative perception across the property industry per se. But ultimately, the sector that we operate in and where we operate in is still as buoyant as it's ever been. The demand drivers, both in SA and in the UK, are at an all-time high. But obviously, as capital has become more constrained, or should we say more expensive, there will be a recalibration of valuations in the immediate, if you like. In terms of where Equites has been, obviously, in the early years, you can see where we were probably in a fairly strong bull market there. You can see in 2017 where our dividend yield was sort of in the low sixes. And at the moment, as you can see, our dividend yield is probably sitting sort of somewhere between 10 and 11% at the moment, which obviously on the back of 100% payout ratio is obviously very reassuring for investors in our business. Next. In terms of the prospects, we've given DPS guidance growth of 4 to 6% for the year. That will equate to a distribution per share of between R1.69 and R1.72 for the year. We've already distributed, obviously, the interim dividend sort of came out about 4 weeks ago. And we believe that we will continue to unlock a lot of value through the developments in the UK. We'll continue to maintain a 100% payout ratio. And we will continue to try and keep we want to keep our loan to value between 30 and 40%. And one of the ways that we will do that is at the moment we are already engaging with potential new equity platforms coming directly out of the UK into the UK business, which will free up a lot of capital for us to reinvest in our burgeoning sort of South African development pipeline. I think this year we will have contracted, if not 400,000 square meters of new build, be very close to 400,000 square meters of new build, which is an all-time record in our history. So obviously it's been a great year, and we don't foresee that slowing down anytime soon, which bodes well for the business. I think that's about it. I think we've tried to do it in 20 minutes. It's normally a presentation that takes a little bit longer than that. But yeah, I think we'll hand over to Marlies and the finance ghost to see if we've got some questions that we can answer.
Thank you, Andrea and Leila. We will now go into the Q&A session. And as a reminder, you can post your questions into the chat box at the bottom of the screen. I'll hand you over to the finance ghost and Mark Tobin.
Hi, everyone. Welcome to Unlock the Stock and to the management team from Equites. Thank you so much for your time today, taking out a very busy schedule to come and hang out with some retail investors and some institutional investors using their Gmail accounts. We see you. No, I'm kidding. So first question, and there's already been some very good ones coming through, I must say, in the DMs. So guys, please keep sending them to me or to Mark Tobin if you prefer to send it to a person rather than a ghost, and either one of us will ask it through. The first question is this: when you guys are doing a new development, how do you think about that initial, and I've always been very curious about this, do you target an initial yield? I'm just thinking of the announcement about ShopRite yesterday. Do you do more of a net present value analysis? Because obviously there's a construction phase where it's not yielding anything, and I guess you need to claw back that capital going onto the ground. And then obviously it's difficult with escalation assumptions. I mean, you talked earlier about how escalations can move so much based on prevailing levels of inflation. So maybe just a chat around how you do your project costing and analysis and what you target.
Okay, so I think if I can start there, maybe. So we have an internal metric that in an ideal world, we would look at current levels, we'd be looking to do a development of between 8 and 9%. Now, that there'll be a function of who the tenant is, will have a bearing in terms of the risk profile of where we would be. And obviously the lower risk, the closer to 8, the higher risk, the closer to 9. So that's the first part. The second part is obviously the escalation. So the better the escalation, the more, I suppose, lower starting yield we can start with. The lower the escalation, obviously we would need a higher starting yield. Now, obviously, Shoprite defies all of those metrics, and obviously with the quantum of business that they've afforded us through the retail logistics fund and the joint venture that we've done, we needed to make a decision. Do we believe that the 20-year steady income that will underpin our business, does that make sense for our business over a 20-year period? And if so, these are the financial levers that Shoprite is prepared to deliver on. And ultimately, when we looked at it within the realms of a bigger portfolio and what we're trying to achieve in terms of sustainable growth for our shareholders, we believe that underpin certainly warranted taking a bit of pain in the short term. And obviously, over time, we will benefit from it. And whilst people might say 5% is very low, but even if you get a 10-year lease from someone, at the end of 10 years, if that tenant moves out, you potentially could have a vacancy period. You could have rentals that have gone out of market. So you could have a reversion. You could have a lot of other factors that come into play after 5, 10, or 15 years. With Shoprite, for 20 years, we effectively have no risk of that. So it is a fundamental underpin of our portfolio. But yeah, ultimately, everything comes down to internal metrics linked to certain IRRs that need to be achieved. And maybe Leila can extrapolate a bit more on that.
Yeah. So, I mean, that's exactly it. So we have a risk-adjusted hurdle. We do risk-adjusted return models. We model the IRR of a development. You asked specifically about where we measure the cash outflows and when we start, measuring rental income. We generally have very good sight. We know that we're going to spend X on land. There's going to be an 18-month development period, and then on Shoprite, for example, there'll be 20 years of recurring rental income growing by 5% per annum. They're fully repairing and maintaining leases, so there's really no leakage in terms of the operational costs. We build in some buffer, and then we can generally measure what that return will be over the lifetime of the lease. Absolutely on, in the terminal value, if we were looking at a shorter lease, there would be more variability in that terminal value. So we make an informed decision as to what rental growth will be over the period and where we think, if there's a reversion, where that will come through and what impact that will have on our IRRs. But at the moment, we target IRRs of between 13 and 14%, and a transaction like Shoprite would have to beat that our hurdle rates in order for us to go ahead and do it. So even though in the short term it may be marginally dilutive, over the long term we're very comfortable that it creates value. And we want assets like that to really underpin the solid property fundamentals.
I can ask one quick one on the Shoprite thing, Mark, and then give the microphone to you, just because I got a question about that exact development in my DMs, and it was is it entirely on your balance sheet or is it in the joint venture? I think from the announcement, it looks like it's on your balance sheet. And then the question is just, why that is the case.
Yeah, so, there are certain assets which we've sat down with Shoprite and we've understood from them what they're comfortable to hold in that joint venture. They have certain capital requirements or allocations to capital that they're comfortable to make in line with a greater pipeline. So this particular development, when we looked at it, we were comfortable to carry it on our balance sheet. It is on land that we currently own. And potentially, we disclosed 2 other transactions which we're doing with them. Those will go into the JV. So really, it is part of a bigger capital outlay for both of us. And
as Leila said, in our interim results, you would have seen that we are doing another 2 deals with Shoprite, one in Durban and one in Quebec, where we're buying existing facilities, but we are extending both of them. So the Durban facility is approximately 55,000 square meters. We're currently already on site there, and that will become 90,000. And the Quebec one is about 15,000, and that will also become 90,000. But those 2 properties will be in the joint venture with Shoprite, so they will retain 49.9% ownership of it. and we will be 50.1% of that. So also very exciting, and as I said earlier, it's the Shoprite relationship really is now, we've almost cemented a cornerstone of our portfolio with 20-year income guaranteed from, probably one of the strongest covenants in the country. And then over and above that, the next question I know that will probably come is, are we worried about too much Shoprite exposure? And within the realms of our portfolio, on a look-through basis in terms of what we own, once we've developed out everything that we've announced already, we'll only probably have about 16% of our income exposed to Shoprite, which is probably, it's above 10% where you potentially would ideally want to be. But I think we prepared it to take Shoprite to 16%. I think it's a risk worth taking.
Yeah, I'm going to steal two questions now since the ghost has got two in. First want to go back a little bit on first principles. The triple net, because the second question is going to come.
Sorry, could you say that again? You were breaking up.
Oh, sorry. Triple net leases. Can we just maybe take a step back and just give an overview of what exactly that means? Because they're probably not that common in other REITs that people, might be more familiar with. It seems to be something that happens in logistics-focused REITs rather than your standard, retail or office REIT.
Yeah. Okay. So, a fully repairing and maintaining lease, which is 95% of our leases are that. Basically, what it means is that all the expenses that are associated to that building, so starting from rates and taxes, are effectively recovered from the tenant. Insurance recovered from the tenant. Maintenance of the building needs to be effected by the tenant. So when we hand over a warehouse, there will be certain requirements in terms of maintenance of the fire system, which would need to be done on a perennial basis, effectively. And the responsibility of that lies with the tenant. Our property managers will stand in the background and ensure that these things are done. And the biggest risk for the tenant, obviously, if they don't do their maintenance, is that we also have fairly onerous reinstatement clauses. So if they were to move out at the end of the lease term and they haven't done their maintenance and there is consequential damage to our building, then effectively the cost of all that consequential damage can be covered from the tenant as well. So the rental that we contract with the tenant, for all intents and purposes, is a net rental. It's actually what is available to us to then distribute onto our shareholders. I hope that explains it.
Yeah, it does, and it nicely covers the second question, was how do you guard against bad maintenance practices by your tenants? So you've covered off that. So.
Yeah, and unfortunately, it is a reality, and we guard against it with a very strong property management team. We inspect our properties effectively on a monthly basis. I think also what's quite nice about the inspection is that obviously our property managers have also been briefed to keep an eye out for levels of activity, stock holdings, and various other things. So if ever there was a tenant that was potentially not in comfortable waters, our property managers would probably pick that up by the actual operations that were being undertaken on a daily basis, effectively. So it's actually quite a nice two-tiered mechanism, should we say?
So the way we build, so the property managers and reconnaissance scouts all in the one job spec.
Mark, but also, I think it's also very important that what we've learned through being in this industry, and me personally, I've been building warehouses since 2006 and owning them since 2000. So I've been in this world for quite a while. What we've learned is that whilst you might have these fully repairing and maintaining leases, maintenance is a grudge factor for your tenant, and especially where things fail. So what we've learned is that to ensure that you keep relationships with your tenants, it is very important that the product that you deliver to them at the beginning of the lease term really does tick all the boxes and it matches expectation. And I think if there is a criticism of a lot of other parties that operate in this space is that sometimes they don't pay as much attention to that factor. We do, in terms of how we've designed our floors. We've really reduced the quantum of maintenance that still needs to be some, but we've reduced it because and hence it's a saving for the client. I mean, on all external facades, we do not use plaster and paint because invariably you need to go and touch that up every 2 to 3 years because our external conditions are pretty harsh in South Africa. We use glass, we use sheeting, we use other forms of cladding to ensure that the external facade always looks professional, always looks great, but really requires very, very minimum maintenance. So we're very aware of these factors, and we have designed and we continue to improve on these things in terms of ensuring that we can hand over a facility where we're not saying you don't do any maintenance, but where we have certainly reduced the encumbrance of that maintenance on our tenants.
Okay. And then just another one for me, we move away from the maintenance side. In terms of the UK locations, I noticed it's from the map, from somebody who used to live there as well, it's kind of a straight line from London to Sheffield, give or take. You know, there's no there's no exposure to, you know, let's say some other interesting nodes in the UK, like somewhere halfway between Glasgow and Edinburgh, for example, or if we go, you know, down southwest part of Bristol, Bath, or, you know, Greater Manchester, London, Bolton, Liverpool. So just in terms of picking those geographical points, has that been deliberate, or has it just where the opportunities are?
I think Mark's just trying to encourage investment in Ireland is what's happening here. That's what that question is thinly dressed up as.
So let's put it this way. It has been deliberate to a point, but we do have very strict investment criteria in terms of where we will invest. So there are probably 2 areas that we haven't invested in that we would if the correct opportunity allowed itself to be there. That would be in the northwest. So the Manchester Liverpool node is a node that we certainly would invest in. We used to have a couple of assets in Stoke, which we sold 18 months ago. And then the other location where we would potentially buy or look at would be sort of on the M4 going out towards Bristol. So Swindon and then going out to Bristol. We don't like the M5. We see that as very much a secondary location. We don't like Scotland. We do have one asset in Wales, but which we did the deal because it was a 25-year lease. But we don't like Wales generally. And then we've also tried to steer clear of the northeast as well. So the East Midlands, for what Equites is doing, remains our bread and butter. That is going to be the core of our portfolio. And obviously you'll see there's nothing in London, and not because we would love to be in London, because it's a microcosm that creates incredible value, but obviously it comes at a ridiculous pricing points. And it's a market that to play in the quantum of capital and the cheapness of capital that you need to operate and to be there competing against the likes of Segro and Prologis head to head makes it, we believe, just way too expensive for Equites. So it will be very, very unlikely that Equites will ever have an opportunity inside the M25. I mean, we do have one opportunity in a place called Egham, very close to Heathrow, but it is a very complicated opportunity and probably will end up being a data center opportunity rather than a logistics opportunity.
Okay. I'll hand back to the ghost for the next one.
There we go. I see there was a very political avoidance of commenting on Ireland there, which I think is probably safest. Let's talk balance sheet instead. So something that's interesting with Equites is
Ireland is, yeah.
No, go ahead. You're welcome to say bad things about Mark's home country. We can all laugh at his expense.
No. But I mean, obviously, the Republic of Ireland obviously is not the UK, and Northern Ireland is such a small market, would be very similar to Scotland and Wales, and for that very reason, you know, we probably wouldn't consider it as an opportunity, basically. Yeah.
There we go. Sorry, Mark. So on to balance sheet. Something interesting about your fund is the 100% payout ratio. Obviously, the other way to do it is to retain some capital and have that for growth. I did notice the relatively low loan to value, so there's lots of room to raise more debt, for example. I've had a couple of questions around this, and obviously one of the other points that's been made to me in the questions is, you know, it is quite expensive to go and do book builds. You got to pay advisors. If you are trading at a discount to NAV, you're effectively actually, you know, diluting the value when you're raising capital at a discount to NAV. So just the way you guys think about that, why the 100% payout ratio, and how that works going forward.
So we've never done a book build at a discount to NAV. Every book build we've ever done has been at a premium to NAV. So I think the costs of paying advisors is negligible in the greater schemes of things. I mean, you know, you need to pay high caliber individuals if you want high caliber services. So that really is not really a consideration in our world. In terms of the retention of that money, we would need to pay tax on it. So historically, our view has always been one of potentially running drips, sort of dividend reinvestment programs, where we would then get the money back without having a tax consequence within Equites. So our view is very much linked to looking to optimize the use of shareholder money as best we can. And in that, you know, at current share price, would we give away our paper cheaply to do a book build? The answer to that question is no. And we will take these opportunities to recycle capital. We've got obviously some of the properties that were in the original listing portfolio. We've already sold 6 of them this year in a Statement 102 transaction. And we've identified probably another sort of 7 or 8 properties in our portfolio that are deemed non-core. And we would look to potentially recycle out of those and then redeploy that capital into the 20-year leases with ShopRite and the 10-year leases with TFG and the likes. Yeah.
I think what's also important is that we, firstly, our leases are fully repairing and insuring. So where a lot of other funds withhold some of their distributable earnings, for capital or maintenance expenditure, we don't necessarily have the same burden that they do because of the nature of our assets and leases. And then the other bit is that we have identified that in the UK, through controlling land, we also control the ability to generate profits from those lands, from those land parcels when we do dispose them or where we undertake turnkey development. So as Andrea said, on Will Plot 2, we're making £5 million of after-tax profit, which is 100 million rand. If we had to withhold, 10% of our distributable earnings, it would be just over 100 million rand. So we identified that we could have other methods of actually generating that capital instead of reducing our payout ratio.
And then can I just put one question, because we have quite a lot of retail investors here, and I know there's a dividend reinvestment program, and it follows on from this point. Are you happy to keep that going when you are trading at a discount, given probably, as Andrea said, in the grander scheme of things, I'm guessing not a lot of institutional players are taking up the DRP, but for the average retail investor on here, it might be quite a nice way for them to accumulate a bigger holding.
So I think the answer to that question is yes, but depending on what that discount is. So the discount that was attributed to Equites in the recent round of dividend payout was, in our opinion, too low, and hence we decided not to have a drip. But if the discount was probably 5% or less, then I think we would, and predominantly because we do feel that everybody's being treated exactly the same, so we'd be comfortable to do that in that instance. But obviously doing a drip at a discount is dilutionary for the future, so we do need to be mindful of that. So it is a balancing act, and there may be some years in the future where we've got no leases expiring, we've got a particular bumper year, and we may still be trading at a discount to NAV, because obviously the one thing we have no control over is our share price. And in that instance, that the dilution may be such that it still makes sense for us to do it. So yeah, we remain very open-minded in that regard, as long as everybody's treated exactly the same. There's no priority treatment.
I think that's fair.
Maybe I can jump in with the question. I've received a couple of them in my DMs on this topic. So it's around geographical exposure, ultimately a little bit of, semigration away from Gauteng, although I do wonder how much that really affects logistics properties. And maybe that's a question in and of itself. And then also the sort of split between SA and the UK at the moment. Any thoughts on how that might all evolve over time?
Yeah, I mean, if we start with the semigration out of Gauteng, okay, what we see is that Gauteng remains the economic hub of the country. I mean, if you need a 10,000 square meter facility in Cape Town, you probably need a 30,000 square meter facility in Johannesburg. And for all the talk of semigration, the economic hub remains there. I mean, we've got a client that will be moving their operation to Joburg next year when their lease expires with us here in Cape Town. And that is just a pure function of 70% of their business being in Gauteng. I mean, you can look at TFG. We're building for them at the moment a 55,000 square meter facility. We've just finished extending their 21,000. It's become, the 24,000. It's become 41,000 now. And the 55 that we're building now can be extended to become 90 in due course, and probably will. And that is really a function of TFG having done a deep analysis of their sales and their warehousing, and the diesel prices to get product from Cape Town to Joburg on order are making the fact that historically a TFG would have probably warehoused in Cape Town 80% plus of their product. In the next 2 years, TFG will be warehousing 75% plus of their product in Joburg, because ultimately 68% of their sales basically emanate out of the greater Gauteng region. So, those are the numbers. I mean, Shoprite have got 165,000 square meter facility with us in Centurion in the joint venture. We're building them another 90,000 because that facility just can't cope. We can talk semigration as much as we want, but Gauteng is Gauteng. It is the economic hub of the country, and that ain't going to change anytime soon.
And just to add to that, I mean, usually when we give this presentation, we talk about the trends that are driving the demand for logistics products. And what we're seeing is, we didn't get a chance to do it because we kept our content quite short, but what we're seeing is that retailers are focused on supply chain optimization. They're focused on a trend which is globally accepted as onshoring or nearshoring, and they're moving away from just in time to just in case. So they're warehousing more stock. And that's what's really causing retailers such as Shoprite and TFG, I'm using those because we're close to them, to increase their footprints. And where they're increasing their footprint still seems to be Gauteng. So they'll have smaller facilities in Cape Town or Western Cape and KZN, but their major hubs will be in Gauteng. And that's really been a driving factor for demand in our sector. And then, I mean, on the UK SA split?
Yeah, I mean, the UK SA split, I mean, we were, this time, we've been having this conversation this time last year. The UK market was powering great guns. SA, we were obviously worried about this year's ANC election in December. And then all of a sudden, what do you have? You have a situation where Putin rolls into Ukraine, the inflation in the Western world, which, the Fed in the US was saying was going to be transient, all of a sudden wasn't transient anymore. And all of a sudden this interest rate cycle hiking came home pretty quickly. The markets, the property markets in the UK, have definitely on a valuation point of view and on a transactional sort of investment point of view have definitely suffered. But on an occupational front and on a vacancy front in terms of the UK property portfolio, I mean, the UK market, it's got about 1% vacancy, which is an all-time low. The take-up this year is probably going to be 50 million square foot plus again. Last year was 55 million square foot, the record year. So the demand drivers are still all there. we will continue to try and do transactions in the UK, but I think we've been taken a little bit by surprise by how successful we've been in South Africa this year. And it would seem that next year is probably going to be equally as positive in SA. So we'll probably hover around these levels for at least the next couple of years. The big difference, though, between SA and the UK, though, is that, I mean, if you took for argument's sake, a 20,000 square meter warehouse in South Africa, a 20,000 square meter facility to an Equites spec would be worth about 240 million plus minus rand. That same warehouse, if you placed it in the East Midlands in the UK, would be worth about 750 million rand. So we need to almost do 3 transactions in SA to match 1 transaction in the UK to stay on an even keel. So as the UK model sort of unpacks itself and we get the commensurate equity required to really deliver on that full force, you know, there's no question that the UK potential is significantly larger in rand terms. Maybe not in square meterage terms, but certainly in rand terms.
That journey from just in time to just in case is fascinating, because we saw it in TFG's recent numbers. You could see the balance sheet growing, you can see inventory, and that's why the share price took a knock. So ironically, retailers putting pressure on their own cash flows is actually beneficial for you, because the cash flows are going into inventory stored in a warehouse. That's super interesting. Thanks for sharing that. Mark, I don't know if you want to get one more in. And I think
I just want to touch on the whale for a second, because, you know, 13 years, it is quite long. And I mean, if I vaguely know a few of the US guys like Stag Industrial or Americold, where, you know, you are pure plays in the logistics space that maybe people can compare with. But, you know, their whales are like between 5 and 7 years.
Yeah.
And so is it a focus to, you know, keep it up that high, or is it just been a function of deals that have been signed over the last like 5, you know, since listing, or is it, you know, we really want to keep it at that like plus 10 years level or plus 13 years level?
I think, Mark, I think what actually happened is that our expectation was that we would try and keep it somewhere between 8 and 10 years, and obviously a function of recent deals in the last 2 years, we've done about, I think, 6 deals with 20-year leases. So that's just dragged everything up pretty significantly. So, you know, the beauty, obviously, of the ShopRite relationship is 20-year leases, but also in the UK, 20-year leases are not that uncommon. They, you know, 15 and 20-year leases are fairly common, and they tend to be where we play. So the function of those metrics are that we will probably stay in the low teens, if you like, for the foreseeable future. Obviously, as the ShopRite portfolio matures, and let's say in 5 or 6 years' time, as those 20-year leases become 12 and 13-year leases, I'm sure that our average will certainly come off. But I think what's also quite interesting is that the function of the fact that we've got this massively long weighted average lease expiry profile, I think also talks to the success that we had in the debt auction market last week, and as we did last year, that we've actually priced in the market at probably 2 notches above what GCR rates us at, and I think that's a function of the internal credits that the various asset managers are doing on us. They take a lot of comfort from the underlying strength of these cash flows that will be coming through us for the foreseeable future. So I think that's also a really good positive for us.
Yeah, and just, I know Marlies wants to wrap up, but I'm just going to say the whale as well for the retail investor on the 100% payout. You know, when you have such a long line of sight on very secure leases with grade A clients or customers, you know, that also gives, you know, the board, I think, a lot of confidence to keep the 100% kind of payout ratio. I'll hand over to Marlies now.
100%.
Thank you, everyone, for participating in Unlock the Stock today. And a special thank you to Andrea and Leila for making the time to support Unlock the Stock. We hope you have enjoyed this event, and if you would like to listen to it again, it will be on the Keyter Rech Investor Solutions YouTube channel. It's difficult to believe this is our last Unlock the Stock for 2022, and a special thank you to everyone who has joined these sessions and have really made this platform what it is today. We have You've all been amazing participants, and we are working hard on the 2023 schedule. So please keep an eye out for the invitations in the new year. All that remains is to wish you a happy and safe holiday. Goodbye.